Okay.
Okay.
Okay, so welcome to today's class. This is our first class in financial accounting, and I am your tutor for this beginning, for the start of this course. My name is Ini. With a show of hands, how many of us were at the open day that was conducted last week? IoT open day. Just show your hands or type yes in the comment section. Okay, AY, Olabisi. Olabisi, I see you're in last diet now. Were you in the last diet?
Yes, I
Okay.
was, but I didn't go for the
Yes.
exams. I was scared that I had not
Ah,
prepared well.
you are one
So,
of the people that they were talking to last week. Oh my
yes,
God.
so, yes, so.
Bukola, I see your Abiodu Bukola. Your name also looks familiar. So how many were in the class for last diet, May 2025 diet? Amaka, I know you. You too, you were there. No wonder. Because when the results came out, I wasn't seeing activity on FA group like other groups. No.
I wasn't there. Raise hands. I was at the open this day last week. I
You were
wasn't in
there,
the
the
last
open
day.
day.
Yeah,
Who's that?
last week.
Amaka. Is that Amaka?
Yes.
Yeah,
I
yes, I
wasn't
recognize your
in the
voice.
class. Yeah.
Yeah. Okay. So I asked 2 questions. Those that wrote last diet. It's Olabisi that distracted me. Because wow. Okay. From the poll that I dropped on the WhatsApp group, I saw like over 50% are new students, right? Many of you are new and you don't have knowledge of financial accounting. So like it's like I'm teaching babies fresh minds, and I really like that. You are welcome to this class. This is why IoT is here for you. My challenge, and I pray that I will not oversimplify the class, so that I pray that I will not oversimplify the class. But financial accounting is very simple and very straightforward. And the reason why I did that was because I wanted to be sure of how I can tailor the class to meet everyone's, or not everyone, because as accountants we cannot do 100% as an auditor, but at least meet 80% of our students' needs, to assess the difficulty level of our students and assess and tailor our classes to meet those needs. That was why I put up that poll, and it showed that many of us are new students, so you don't have financial accounting background, but that is not a problem. That is not a problem at all. If you put your mind down, please free your mind of any anxiety and what you've heard outside. Forget that you're writing ICAN and treat financial accounting as a paper that you are learning for your own business. So see yourself as the business, and you are learning financial accounting to help you. Okay, so this class is a 3-hour class, and I know that our attention span can be stressed because of the volume of courses that we have. I know I could see from the calendar that we had already done management accounting this morning. Am I right? Hello, did we do management accounting this morning?
Yes, we did.
Yes, we did.
Yes, we did.
So you are coming off of that and you are entering another accounting, financial accounting. So I will try and give us little time to break time, so that you can relax your brain and not to make this first class too weighty. Okay, another thing that we talked about, or rather I dropped on the group, was for us to look at the syllabus and download the study pack, at least 2021 study pack. How many of us did that? How many of us did that? Okay, Bukola did. Thank you so much, Bukola. Thank you, Bukola. I'm trying to share my screen. Mercy, yes, Mercy. Thank you, Mercy. Who else again? Fatima, thank you. Gift, thank you. Okay, So those that did, what did you discover? What was your observation? I just said we should compare the syllabus for FA and what is in the November 2021 study pack. So what were your observations? Nobody wants to say anything. Please talk now. So can you see my screen, please?
Yes, you can see it.
Okay, thank you very much.
See.
Okay. Quickly, what I want to show us is okay.
Sorry, please, I can't see this.
How many cannot see my screen? I can see my own screen, Sal. Are you sure it's not your network?
My network is okay, ma'am.
Please check again. You seem to be the only one that says they can't see my screen.
Okay, I will close and re-enter. Maybe it's from my own end.
Please do, sir. Thank you. Okay, what I like to do before we go into the course is to show us what we are dealing with in this course. Okay. And I also want to prove something that yes, for financial accounting particularly, yes, we are operating a new syllabus, but so that we don't say that, oh, materials are not out, there's no study pack, we cannot read, we cannot do this. I want to show you that you can work with what you have. Okay, I want to show you that we can still fire ahead with what we have. So we can see for financial accounting, you can see the linkage. So this is your 2025 ICAN syllabus. And you can see this is where we are at. We are here, financial accounting. And the link courses to financial accounting is your corporate and business law. That's the new name that has been given, corporate and business law. It used to be called business law before, but now it's now corporate and business law. Those of you that are taking the course can tell us what the difference is. So from your financial accounting, you can see the linkage to financial reporting and then strategic business reporting. That is at the professional stage. Now, the syllabus overview is what I want to show us. So over here on the left, my left is the professional syllabus review. And this is the syllabus review in your 2021 study pack. If you look with me, can you see any difference? Please, you can. If you are using a laptop, also try and access the documents that I'm using. Yes, Madam Abiola, your hand is up. Your hand is raised. Do you have a question? You can unmute your mic and ask the question. Okay, you've taken it down. Okay, so you can see from the syllabus review in your 2025 in the new ICAN syllabus and that of your textbook. We have the grid, accounting framework, recording financial transactions, reconciliation in financial accounting, accounting for transactions in the financial statement, 20 marks. It's the same thing here. Accounting for partnership, not-for-profit entities, and incomplete record. Same thing, 15%. In your 2021 study pack, the same thing. Under number F, you're treating financial statements. In your study pack, financial statement. And then the final one, G, says virtual accounting. And your study pack, you have virtual accounting. I was going to leave this section to the end of the course, but I think we should just deal with that. Let's know what we are tackling. I always like to know the size of the, let's know the stature of the, I won't call them enemy, but our opponents in the 2020 November 2025 diet. So you can see here the detailed syllabus and the detailed content. ICAN says that for the November 2020, going forward for 2025 diet, the accounting framework, scope and purpose of accounting. Please, as I'm calling it in the syllabus, be looking at it in the study pack here on the right. So you can see A, scope and purpose of accounting, and under that you have define accounting and state objectives of accounting, differentiate between accounting and bookkeeping, explain the different types of accounting. You can see it's the same on my right in your study pack. Number 2 says identify users of accounting information and their needs. You have that in chapter 1 and 2 in your study pack. What has changed is your item number 3, that says explain the IASB conceptual framework for financial reporting in relation to general purpose financial reporting. If I just tell you to talking about the IASB conceptual framework, and that is what you here. If you go to your chapter 2 in detail, it says explain the qualitative characteristics of useful financial information. That's basically the content of this number 3 is the same thing as what is here. If you go through your chapter 2 in your study pack, this information is there. And if you stick with the class, I will also provide notes, clearer notes on this topic as well. If you go to number 4, it says elements. So number 3 and 4 in your study pack, list and explain elements of financial statements. This is the chapter 2 has been merged under your number 3 here. You can see it here, elements of financial statements, including recognition and derecognition, measurement and presentation disclosure. These are items that fall under the accounting framework. Is the foundation of the financial accounting course. Then here number 4 says explain the accounting concepts and conventions, and these are all the concepts and conventions here. They stopped at K, but in your study pack you have up to I. So what did they add? I don't want to talk too much. I don't want to be the only one talking. So let me know that you are following. What difference what did they add in this accounting concept? Thank you. So this diet, you are to learn duality. What else? Sorry, I might not know your name, but your voices are sounding familiar. The person that just spoke now, I know your voice. Oh, it feels like I've heard your voice before. Please, what's your name? Sorry?
John.
Hello, John. Were you in May diet?
No, not in this class, actually.
Oh, okay. Because I know your voice sounds familiar. All right. So duality. What other concepts are you did they include for you now? Someone has identified offsetting. No, offsetting is there.
Offsetting is there already.
Cost and current cost conventions.
Historical cost and current cost conventions. So I think that's what made it go from so they added 2 more concepts, historical cost and duality. And you don't have a problem. That is easily remedied. We are going to, in fact, the notes for that one is already available. So this topic you can read. I'm not saying that you can read. I won't teach you to. I'm just saying that you can see the material for it is there. And if it's the institute that I know and love very well, they won't change much. The new study pack, when it comes out, will still basically contain 80% of what you have here. It's just little inclusions of the new topics or concepts that have been introduced. If we go further, so here you can see you have basis of accounting here, discuss accrual, cash and breakup basis of accounting, still in chapter 1. And then here to explain accrual and okay, they removed breakup basis and said explain only accrual and cash basis of accounting. Then for the number 6, the regulatory environment of accounting, explain the need for regulation of accounting practice, identify the regulator of the accounting practice in Nigeria, which is your FRCN. They say the same. So here they said explain the need, identify the sources. So it's basically the same. They didn't say FRC in your note, but if you check your notebook, there's FRC and there's CAMA. They are there. Number 7 says explain the ethical considerations for preparers of financial statements. So this is also in your chapter 1, but they brought it out as a topic, as a standalone here. And then number 8 says state the roles of accountants in business and the economy. State the roles here. So and then number 9, that is the latest addition. They say state the duties and responsibilities of those charged with governance. So this number 9 is kind of like is introducing you now, which is a very good thing. It's introducing you now to a concept that you will meet when you get to skills level, when you are doing audit and assurance. This concept of those charged with governance, you will meet it when you get to skills level. So now we are being asked to teach it at foundation so that you are familiar with it. Hold it in your left hand. Okay. I don't want to spend too much time because my plan today is that we are going to start accounting, financial accounting today. But I just want to show you what we are covering. So your chapter 1 and 2 is what we are dealing with. You can do by yourself. Now that I've shown you what I meant by compare what the syllabus says and what your study pack says, I believe you know how to do this for yourself. So go back, take it up. You need to be able to size up what you are dealing with when it comes to ICAN exam. Many times the examiner says that students do not familiarize themselves well enough with their study, with the ICAN study text and past questions. So now that you can see the items, your brain should now be calculating what and what this class and what you need to know in this class. Okay. Look at section B here, recording financial transactions. This is 15%. So here they are saying identify sources. You can see it's your chapter 5, your chapter 3 and 4. Apply double entry principle. This is it here, the double entry principle. Then state the usefulness and limitations of trial balance. That's the number 4, state usefulness. So what they introduced newly is procedures and documentation for banking of monies received. Explain the method of funds transfer, including handling, storing, and security of monies. Explain the uses of debit and credit card. Without us even starting the topic, is this something you can explain? Funds transfer. Please, who can explain the method of funds transfer? Just from your day-to-day, will I say, layman understanding, funds transfer. Anybody? Let us be an interactive class. So. Somebody try, give it a try.
Fund transfer is just, simply the process of transferring funds from one bank account to another, and for normal day-to-day transactions, of course, you check the balances in that bank account, for the business bank account. Maybe like I'm transferring from First Bank account to Standard Chartered account, and then I'll utilize instructions. So
instructions and what again?
Yes.
What's the vital thing that you utilize for a funds transfer? When you
The
think of
signatories have
funds
to
transfer,
say.
no, you are even
Okay.
going far. What they're
Okay.
asking, so what ICAN has introduced here is online banking, like your online internet. You know, we are now
Okay,
trying.
internet.
Yes, the use of the internet now, our
Okay.
sophistication in our transactions. As an accountant in day-to-day work now, you can't just be, before when our senior uncles and all those our senior colleagues used to go to, when they were doing transactions, it was carrying cash physically from one place to the other. But now with funds transfer, it has reduced the actual physical handling of cash. Transactions can be done virtually, which is another link to your virtual accounting that we're talking about. So that's what ICAN has now introduced here. And how do you record all those funds? Here now you can talk of signatories. How do you handle money? How do you store it? Security of monies. You can now talk about ensuring that the organizations or businesses have to ensure proper authorization processes are in place. Then the use of debit and credit card. Please, what's a debit card? In Nigeria here, all I know is debit card. Is abroad, I know that they used to do credit card. Please, I know we have bankers in our midst too. So if you are a banker, please, can you just share with the class the difference between a debit and a credit card?
Okay, let me give it a try.
Fantastic. Please go ahead.
Okay, so good afternoon, everyone. So a debit card is the card that we use day to day. So money is taken directly from your account when you make purchases. While a credit card, which is not very often used in Nigeria, allows you to borrow money from the bank, then you pay later, maybe at with an interest rate or so.
Oh, fantastic. Thank you. So the debit card basically operates from the balances that is in your bank account, right? While the credit card is like a loan, an advance that is being given to you for a fee. That's what I got from your explanation. Thank you so much for that. So you can see that with that one now and all the other, and then what I noticed, I said I was going to bring it up. For the double entry principle, what ICAN has introduced under here, this, please mute your mic. Please, let's mute our mic. I'm not sure I have the ability to mute everyone. Let's try and mute our mics. Okay. What was I? Where was I? Okay. So see what ICAN has introduced. Calculation of VAT, posting to the ledger, transactions with elements of VAT. What else again did they introduce? Under double entry principle here, we only had 4 topics: accounting equation, rules of double entry, ledger accounts, entry principle, and balancing ledger accounts, extracting trial balance. What did they do here? So I can see VAT. What else did they put? Oh, okay. See here too. Explain the general principles and operations for value-added tax. So when you explain the principles, you also show the calculation of VAT and the ledger postings. Okay. So far that's it. So please go and look through the syllabus. It's very interesting. Compare it with your 2021 study pack and start studying. You are not too early. I can already tell that by the number of people that are here, those that will pass, because you have started early. Okay. And please, if I'm speaking too fast, kindly, you have my permission in an orderly manner, in an orderly and professional manner, to call my attention to my speed, please. Okay. All right. So let's go dive into today's topic. So I said for today's topic, you can see I was already planning for us on this class. I already put a class outline because I want us to achieve as much as possible. FA is a very, very deep topic. And so we're going to be looking at the scope, types, purpose of accounting. We'll look at accounting concepts. We're also going to be looking at types of businesses, business transactions, financial statements, the users of financial statements, elements of financial statements, and then, okay, we've already done this part. Taking discussions and a look at your November 2025 ICAN syllabus. We've done that. So let's look at the scope, types, and purposes of accounting. Yes, I know somebody's already thinking material, study material. Am I right? Somebody's already saying, we didn't get material, I didn't share materials. Okay. The reason for that is because I need your attention. And I've come to find out that material students will identify, you accumulate materials, but you will not go through it. So this material is available. I will drop it at the end of the class, but I want us to discuss and go through it, and I need your attention. So from your own perspective, what would you define? How would you define accounting? SARS and Mars. Somebody unmuted. How would you describe financial accounting? There are two elements. There's the financial and there's the accounting. When you think of financial has to do with value, right? Figures, monetary value. Let me say monetary value. Accounting has to do with recording, record keeping. So when we now put that together, we are saying that accounting, let me start with accounting first of all. And when it comes to recording, you are identifying transactions, you are recording transactions. What else are you doing in accounting?
Analyzing.
You are analyzing. Thank you for that. What else are you doing?
Summarizing.
Fantastic. You are summarizing. Sorry, this is 2, 3, 4. You are summarizing.
You're communicating.
And you are communicating something to people that we call. You are interpreting. 6, interpreting.
And we are also making financial decisions from it.
The account here, thank you for saying that. So the accountant is not the one making decisions. The accountant is collating and computing all this information for people that we call end users. It is those end users who end up making a decision about the information that you have provided. Is it clear? So you as an accountant, you are the quote and unquote, I'm sure you've heard this word, you are the steward of your organization. You are identifying, you are recording, you are analyzing, you are summarizing financial information. Let me give this example. If something happens in your office, for instance, a director, is this good? But just for the sake of it, a director slaps a secretary. It's an activity that happened in the office. But as an accountant, do you record? Are you recording that activity? No. But the minute the director slaps the secretary and it ends up being a medical emergency, so that the secretary was now taken to the hospital, and then the business had to sort out medical expenses to the tune of 2.5 million. $2.5 million. It becomes a financial accounting transaction. You now have to record it, analyze it, summarize it, communicate it to the end users. So either you communicate it as suit, maybe legal fees, damages, if the secretary decides to sue the director, or hospital fees, or emergent, you shall have, but as soon as there's a monetary value attached to that business activity, it becomes a transaction, a business transaction, which the accountant must now record and identify. So for me, in my own way, I would say that the accountant's duty are primarily two things: recording and summarizing. Because, and I say that because in recording a transaction, you must identify it, you must classify it. For those of us that already have done this course, you already know when we say classification of items, when you are recording, you're already identifying the item and you are classifying the item already. And then in summarizing, when you are preparing your financial statement, you are analyzing it already. And what else? You are analyzing, you are summarizing it. Summarizing, that's already there. And you are communicating that information to the end users. But for the sake of this, so we just say that accounting is the language of business, because it provides a standardized way of communicating financial performance and position. In the Nigerian context now, as an accountant, when you are recording and summarizing this information, you will have to follow some regulations prescribed by a body of people that we call, or by an act that we call CAMA. And CAMA is the Company and Allied Matters Act that has been revised. So we are following, it used to be of 1999 or something, but now we are doing 2020. It's at 2020. And we are also following IFRS. IFRS is International Financial Reporting Standard. But when you break it down to the Nigerian context, we are following the Nigerian Financial Reporting Standard, NFRS. Please don't be the same thing as Nigeria. Nigerians, we copy and paste. So it's the same accounting standard from IFRS that we are using in the NFRS. And because of our study, we don't want to start having to confuse, so we just call it IFRS. But when you drill down, those IFRS is adopted by the Financial Reporting Council of Nigeria, which is what I put over here. Sorry. Then I want to make, so adopted by the Financial Reporting Council of Nigeria. So they are the ones that they adopted the IFRS and help to ensure that Nigerian businesses are implementing those standards in their transactions, in their financial reporting, in the way they are reporting business activity. Okay. So I said, what are the objectives of accounting? The primary objective of accounting is to record financial transactions. So this note, I'm reading, but I'm explaining because God helps me. I make sure that I try to break down so that when you are reading it, you'll be reading it and you are seeing the examples. Okay. Which is why I said I didn't want to share it yet, because if I share this material, you won't even bother coming to class. Okay. So we record financial, the objective of accounting is to record transactions. You are systematically documenting business transactions in monetary terms. Example, sale of goods worth 500,000 by Dangote Cement to a distributor in Lagos. There is a standardized format prescribed by your IFRS accounting standards on how this sale or this business activity or this transaction is to be recorded. So you and I, as a layman, we are going to say, oh, we bought goods, we sold goods worth 500,000. But when you are, as an accountant, when you are communicating this transaction, you're not going to write it like this. There's a way, there's a principle that we follow, and that's what financial accounting is here to teach you. Another objective of accounting is providing financial information. Like we said, we are supplying relevant data to stakeholders for decision making. Later down the course, you find out we have to look at who are these stakeholders, who are these users of financial information. So an example here is GT Bank's annual report showing profitability. You prepare that, the accountant prepares that report so that for shareholders and potential investors, so that the shareholders, excuse me, Shareholders, so that they can give us more money. Shareholders give us more money. Investors do what? Oh no, let me rephrase that. Shareholders are who? When you hear shareholders, just in your give an idea. Let me
They
know that you have an
are
idea.
they are the owner of a company.
Most times, shareholders are owners. Shareholders are owners. They are the owners. And they are the ones that most times they give the founding capital, the startup capital for those business. And then investors are who? Who are investors?
There are people that invest their money into your business.
Okay, we call them okay. Yeah. So sometimes businesses can fund money called debt via what we call debt. They can go into debt. So investors are the ones that lend to businesses at an interest rate. They will charge you something for it. It's never free. It's not free money. So you can start up a business using owners' funds or using debt, which is other people's money. Please help me write other people in your mind, okay? So you can fund the investors that in other people's money. So before other people will give you money, they must see financial data to make that decision. They must know, and there are certain things they are looking out for, which we'll go into. The third objective of accounting is to determine financial position. When I say financial position, that's the balance. Sorry, that's the balance sheet. Sorry about that. So show the asset, liability, and equity of a business at a specific point in time. So my people that are just coming up, just I hope you have a pen and paper, a notebook. Oh, this is not Netflix and chill. Please have a notebook and paper with you to take note of some of these things, because I know some of you have questions which we will answer at the end. So asset, note these things: asset, liability. Assets, liabilities, and financial position. What are we talking about when we say financial position? Example, now we're saying a statement of financial position showing that ShopRite has 50 billion naira in assets. As an accountant, in accounting, you know you're going to learn how to prepare a statement of financial position that shows the assets of a business. And then the number 4th objective is to measure business performance. When we're talking of when you want to measure business performance, there's something we are talking about, and that's comparability. As an accountant, when you are preparing your account or recording your transaction, the aim is so that you'll be able to compare performance. And the comparing performance could be compare performance from periods. You can compare performance for entities. So when I say periods, I mean maybe you want to look at revenue projections of MTN for 2023 to 2024 period. Please, 1 minute. Somebody is at. Please give me a minute. Hello, so sorry about that. Okay, so we are saying that to compare performance, we are either comparing periods. So you are looking at, I don't know if I'm sure you've heard of it, when they are doing business news, they'll say they are comparing Q1 to Q1 of 2023 and Q1 of 2024. So because of the preparation of financial accounting, you are able to compare periods. You're also able to compare performance of entities. You can look at performance of MTN and 9Mobile. Businesses that operate in the same industry. You compare their performances so that you can see how they are doing. You can look at their profitability, you can look at their growth over a specific period. Maybe the revenue of MTN Q1 was better than the revenue of 9Mobile in the same period. So you can do that in financial accounting. And then, like my sister said, facilitating decision making. You provide information for planning, control, and strategic decisions. Now, like we were talking about saying earlier, decision making. Who are the decision makers? But before, okay, if you can, who are these decision makers? Who do you think are the people that will need this information?
Some of them are investors.
Some are investors.
What?
Say that again. I
POS
didn't get
also,
that.
they need
The board of directors.
Creditors.
BOD, yes. Board of directors.
Yeah.
Creditors. I heard creditors.
Yes.
The government.
Creditors, yes.
The government.
Government. Financial institutions. Financial institutions. Let me call them FIs. So all these people, they have different decisions. Shareholders, yes. You said shareholders. All these people have decisions that they want to make at some point in time for different things. So we have people that are internal users and external users. So for example, that I put here, if you can use cost accounting, like the management accounting, we used to call it cost accounting before. Like management accounting is I'm sure you were told then that is an accounting that is used internally for the decision making of managers, right? So if a company wants to decide whether to expand from Lagos to Abuja, there's a certain type of accounting that you as an accountant would do that will give them that information. Okay, so that's what it just points to the thing that depending on the user of the account of the financial statement, that will determine the type of financial statement that you prepare. And that's why it leads us to something. That means, okay, let me not jump ahead of myself. Another objective is ensuring legal compliance. You remember someone mentioned government, and most times who are those are the people that when they talk about compliance is government we have in mind, right? So if you want to meet up with statutory requirements or regulatory standard, there's an accounting that needs to be done. Either you are preparing accounting, you are submitting annual returns to CAC, or you are submitting annual reports. Remember I said annual reports to FIRS. So depending on who your regulator is, that's the person that you will need to ensure comply and produce your statements for. All right. So now there are two things. When we get to types of accounting, we are going to make. Okay, let me scroll down so we can see that before I come and talk about bookkeeping. Yeah. So, based on what you said now, like I said, there are different users based on what they need the accounting information for. So accounting can be classified into several types based on users, purpose, and scope. It's not written like this in your textbook. They just lumped it, but I decided to split it so that we can have a better view of what we are talking about. So now, based on users, these users that you mentioned up here, investors, board of directors, creditors, and the likes. Based on these users, some of them would require management accounting, some will require financial accounting. So for financial accounting, we have financial accounting, and financial accounting provides information to external users. And who are those external users? You can see them here. Our external users are, so we have external users, as well as internal users. And then I can put here in this third column the type of accounts that will be prepared for them, right? So for an external user now, who is going to need financial accounting, you have investors. You mentioned it before. You have your creditors or suppliers. You have the government. You have the general public. So these make use of financial accounting. And so the reports that they'll be looking at is your what we call income statement, statement of financial position, and your cash flow statements. Don't worry, hold it in your left hand. I will explain in detail further down this topic. And then you have examples of those like Nestle Nigeria's annual report published for shareholders will be filed with Nigerian Stock Exchange. So some you have when I get to business types of businesses, you will see that there are some businesses and their legal requirements. But just for now, based on users, so users like this, Nigerian Nestle Nigeria public, what we call public limited liability companies, they will use this type of accounting, financial accounting. Then when we get to management accounting, we call them internal users. So this management accounting provides information for internal management decisions, and that will be who? The CEO. So we can say for your CEO, your head of department, HOD, even you as a staff employee. Who else again? The board, right? I call them internal users. So they will make use of management accounting. And what kind of reports will this kind of people use? They will use budget reports, cost analysis reports, performance reports. For those that were doing BMF, and now they've changed it to business environment, I know that you recognize some of these things, but they've expunged it from the 2025 syllabus and pushed it into your skills, okay, which is a good thing. Although if you are doing BE, business environment, we also repeat what we did today. We'll look at the difference between last diet, last syllabus, and this current syllabus. So what they did in BE was that we used to do something called finance under BMF, where you be looking at budgeting, how to do capital budgets and the likes. So those kind of reports are actually under management accounting. If you are, since you are doing management accounting now, you will get to a stage where you you will learn how to prepare some of these reports. So those reports are used for internal management decision. And so here, example here is that Zenith Bank's internal cost analysis to determine branch profitability across different states. So if they want to know Alagomeji branch, or let me say, Alagomeji branch and the Wuse branch, how are they performing? What's their, maybe the zonal head wants to compare performance, revenue projections, cost analysis. They will use management accounting, not financial accounting for it. I hope it's clear to those of us that are new to this topic. And then based on time period, there's something we have. We have historical accounting, and those are transactions, that's reports. It's historical accounting records and reports past transactions. Example, when you are preparing 2023 financial statements for Zenith Bank, showing 2023 performance. So that's what we call that historical accounting. And then when we are doing what is called current accounting, we are dealing with present transaction. So for instance, someone like Jumia, someone like Temu will do daily sales reports. That's a current account. They are looking at what they've done, what did we sell, what's the value of the goods that we sold today or this month, is current day transaction. And because of technological software that we use, e-commerce software that we use, those reports are very easy to spool. Even you in the bank, I think you have what they call end of day, right? Please, am I right? I'm not a banker. I don't work in the bank. Oh. You have your EOD reports that you do. It can be the number of new accounts that you have opened, right? Or number of please now help me. What's that thing? What do you do on a current your daily transaction reports in the bank? Okay, I know you know. That's why you are quiet. All right. So the next type is budgetary accounting This focuses on future planning, and this is usually done by what we call non-profit organizations or government MDAs, government departments. It's done by the government, budgetary accounting. Then based on nature of the entity, when we get to classification of businesses, you will see that we have what we call, under businesses, we have commercial entities and we have non-profit entities. So commercial accounting is for profit-making organizations. And then government accounting, or what ICAN calls public sector, is for government and charity organizations, NGOs. Some of them use this. So what we are saying, okay, let me not confuse it. For public sector or government accounting, we are going to, there's a type of accounting, it's budget that they use. But why I'm calling charity organizations is because, what they have in common is that they are not for profit. They don't make profits. The aim or the objective of this type of businesses is not to make profits. But when you are an organization that is called to make profits, so at the end of this one, what they show is at the end their own result is surplus and deficit. Please help me spell surplus and deficit. But for a commercial organization, profit making, what they are showing you is profits and losses. So that's the difference. Then you have what is called non-profit accounting. So this is based on the nature of the entity. You have accounting based on nature, non-profit accounting for charity organizations. So that's the kind of financial reporting that Tony Elumelu Foundation will be doing. Then specialized type. Remember I said this one is not in your exam, it's not in your textbook, but I just split it for better understanding. Specialized type of accounting is your cost accounting, which focuses on cost determination and control, calculating unit cost of a bag of cement, of producing a bag of cement for Dangote factory. Tax accounting, when you get to skills, you will be introduced to taxation. That's a different skill set from financial accounting, but it deals with how to calculate tax computation and compliance for businesses. So you learn how to prepare. There's a way you prepare corporate income tax returns for submission to FIRS and your state revenue service. Then what ICAN has introduced at skills level, forensic accounting. I used to hear forensic accounting because I like to watch all this mystery game, all these mystery movies, crime, investigation. So that's where we used to hear forensic reports. Is anybody like me? You used to watch crime, what's that thing? Law and Order, CSI. Unfortunately, Nigeria does not have any, Nollywood has not done any interesting crime movie. But yeah, so we have forensic accounting, and this is to investigate financial fraud and disputes. And it usually targets like for court case, where there's going to be a court case, litigations and all, you could be called as a forensic accountant to prepare forensic accounts. So when you're investigating suspected fraud in maybe the bank's loan portfolio, you even have forensic accounting for couples that want to divorce. You want to dig up, is either of the partners, are they hiding assets? Because sometimes the court would require that assets should be split between couples. You can get a forensic accountant to help you investigate and ensure that there is no marital fraud going on. And then you have environmental accounting. Now, this environmental accounting is interesting because IFRS has introduced what they call sustainability reporting. So it has its own framework, it has its own manner of presentation, its own recognition and measurement basis. But it's still part of, as an accountant, as an accountant, you can decide to specialize in any of these fields. As a non-profit accountant, cost accountant, tax accountant, forensic accountant, sustainability reporting accountant, or a financial accountant, or even an auditor. Okay. So any of that will suffice. So I also put it here. There's performance management, even auditing. I will share this material with you. So, like I said, I just brought it out so that it would help us. It will just build understanding. Now, part of the accounting system, as we are operating, as you are recording transactions, I mentioned it earlier, you are what we call a bookkeeper. So you are doing what is called, you are using what they call bookkeeping system. And this system is what all business transactions use for recording transactions. So there is a difference between the bookkeeper and the accountant. Any idea what that is? Any idea? What's the difference between a bookkeeper or bookkeeping and accounting? What do you think would be the difference? If you look at the notes here, where was it? So I mentioned it here as number 10. I said bookkeeping is the process of recording financial transactions in accounting record. It incorporates posting transactions and extracting a trial balance. Those of you that have done this course before, I'd like to hear your views.
I think a bookkeeper records day-to-day activities or records financial transactions, but an accountant go as much as preparing financial statements and all other financial statements in a company or an organization. But a bookkeeper will not do to an extent what an accountant is doing, but an accountant will do what a bookkeeper is doing and more.
Any other opinion? Please unmute your mic. Gifts. I can see your hand is up. Gifts, and then isn't it? Please, I can't hear you. Hello.
Require any special skills, but accounting
You said?
I said bookkeeping does not require any special skills, but accounting require a special skill and knowledge too.
Special skill, no special skill and knowledge.
Yeah.
Okay. So this one needs specialized skill. I remember last I said that this person only prepares up to trial balance, Abby. Is that what you said, please? Sorry. And then the accountant prepares financial statements. That's what I heard you say. Anybody else wants to try? I saw somebody else's hand up. Yes, Mr.
Okay. An
Adesua.
accountant.
Okay. Yes, sir. Please go ahead.
An accountant does the work of a bookkeeper, but a bookkeeper, the scope of his work does not encompass what accountant does, because the accountant is the bigger one. The bookkeeper is subordinate to the accountant.
If they hear you, they will be happy. So you're saying a bookkeeper is a subordinate. And this one is superior. Okay. But as an accountant, most accountants do not like, well, for me, a personal experience, when I was working before, the accountants there, they would decide they won't do bookkeeping work. Because most times the bookkeeper's work is clerical, recording. Okay, someone said that recording records day-to-day transaction. Day-to-day transactions. You're right. Well, in terms of professionalism, sir, yes, I will agree that somebody subordinates to superior, because as an accountant, like you are writing ICAN now, Adesua, please, I'm coming. You require specialized skill, like what Madam said initially. So that would make you more superior to the bookkeeper. For a bookkeeper, or once you can understand the principles of recording, because recording too, it's not like you just be writing anyhow. You have to follow certain principles in recording transactions. But what I would have said, while the bookkeeper records day-to-day transaction, what does the accountant do? Remember that watch definition. Yes, Madam Ezine or Zain, please raise up your. I don't want to lose this screen.
Okay, can I speak?
Is this Mr. Razak?
No, this is Oluwasegun.
Oluwasegun, okay, please go ahead. Yes.
So I think bookkeeping has to do with recording daily transactions, right? And it's not just even an accountant can do a bookkeeper's work, right? But what the accountant does is the accountant analyzes those data that are being being imputed onto whatever system. It could be Zoho, it could be QuickBooks, it could be Sage, whatever. But the accountant does more, right? But I think nowadays, even the accountant does bookkeeping work, basically. So
okay. So you analyze, record, and then there's a word I've been waiting for: interpreting.
Present and no,
presenting, because you have to interpret the daily transactions. You have to as the accountant, you are the one that convinces the users, whoever is the decision makers. Your presentation, you are the one that presents the financial information that they will use to make their decisions, not necessarily the bookkeeper. The bookkeeper, and then sometimes, so why you are saying is because in an organization where there is no bookkeeping, being done, that's nobody is keeping record. Before the accountant can get to financial statement, he will have to clean up the record keeping system of the organization, of that business, before he can get to this financial statement. Okay, so in terms of decision support, the bookkeeper does not give, so it doesn't provide any supporting information that will help decision makers, but the accountants give support to decision makers. And then, like I said, for qualification, bookkeeping does not require any special skill, just basic education. But for the accountant, you need specialized skill. You can even see, based on the types of accounting that we have, a bookkeeper won't be able to do it. Okay, so well done. Yes, you guys are all correct. You are all correct, and you have spoken well. All right, so we finished the first bullet. All right, yeah, we have finished the first aspect of it. Now I said, okay, maybe I should do this. Let's just have a quick quiz to step down. Just 5 questions. Apologies for the. So these are the options here, the format here. So you can see A, B, and C. So look at this question here. Multi-choice here. Try and expand it so we can see better. See what I'm saying here? So I said, according to the Nigerian regulatory framework, which body is responsible for adopting International Financial Reporting Standard, IFRS, in Nigeria? So, looking for your answers.
Option B.
Sorry? What's your answer? Option B.
Option B.
Option B.
Yes.
Okay. Okay. So option B.
Questions
All right.
are not clear. Let's see the options.
It's not clear. You can't. Okay. Sorry. It's the way I should have put them like your past question. Let me expand it a little more.
Yes, I can see it well. Can't see them.
Okay. Can you see it now? Is it better? Can you see it
still
now?
can't see it.
Please, ma, can you zoom?
You can zoom it now. You can zoom it to see it
Please, ma,
clearly.
can you zoom it on your device for me, please? You can zoom it. So look at question 2. We just did it. What is the primary difference between accounting and bookkeeping? A, accounting is more expensive than bookkeeping. Let me read it. So okay, if you can't see it, let me. Let's finish
The answer is
first now.
D. The answer is D. I mean C. Sorry, C.
The answer is C.
C.
Hey.
Yes.
Okay, number 1, we said B. Number 2, what's the primary difference between any other option? C. Somebody says C.
Yeah, C.
C.
Accounting
What does
includes
C?
analysis.
C. So C
Accounting
says
includes
accounting includes analysis and interpretation, while bookkeeping focuses on recording. What was option? Option A said accounting is more expensive. No. Bookkeeping involves decision making. While account, no. So C, yes, you are all right. Correct.
Okay,
Number 3, question 3. Which type of accounting would be most appropriate for the Federal Ministry of Budget and National Planning?
A.
Please read it.
B. Government accounting.
B says government. B, yeah. B, ma. Not B, not commercial accounting. Commercial accounting is for profit-making organizations. Okay, I know what happened. So this is how you. Did I say that the format of your financial accounting exam? Please let me say it now. Or should we quickly finish? The reason, okay, let me quickly finish. So we are at number 4. Please remind me when I said I want to talk about the format of your ICAN exam. Okay, number 4 says if MTN, forgive me, if MTN Nigeria wants to analyze the profitability of its operations in different Nigerian states, which type of accounting will be most useful? A, financial accounting. B, tax accounting. C, management accounting. D, environmental accounting. Which one?
Management accounting.
Management accounting.
Financial accounting. Financial accounting.
Read it oh.
Management accounting.
Financial
Environmental
accounting.
accounting. Environmental accounting.
Who is saying that
Financial
environmental
accounting.
accounting? I will beat you. No, I won't beat you.
Financial
I'm
accounting.
not
Financial
Management
accounting.
account is for
Accounting.
internal. While
Management accounting.
okay,
Financial
so I have two
accounting.
management accounting, 2 financial accounting. Okay. Question 5. So people are saying A and C. Okay. The 2 groups, you have taken your camp. Don't change it when I now give the answer. All right. Those of you that someone is saying D again. After that, I will beat you, but no problem. In the interest of
There's no
democracy.
problem. We are going with management accounting.
No problem. I like that. Final answer. Okay. Question 5 says, which of the following is not an
I
object?
don't go with management accounting now.
Don't worry. Stay the group that you are
I'm
going
not going
with.
with
Stay.
management accounting.
If there is someone with management accounting,
Please.
I've recorded it. No problem. That's fine. Number 5, which of the following is not an objective of accounting? A, recording financial transactions. B, providing entertainment to stakeholders.
B.
C, measuring business performance. D, where's my B?
That is B.
B.
Providing
Entertainment to
Entertainment to
stakeholders.
stakeholders.
Why? Let's make them dance now. Okay. Number 5, we said B. Here's the rest of my questions. Okay. Wait, people should close your eyes first. Look at my answers. I'm coming. There were more. There are more questions. I think it's 10. Found them. You will see the answer. I will hide it. People should close your eyes. Don't look. Yeah, let's finish it. Number 6. A company like Dangote Cement preparing its annual report, number 6, for shareholders would be engaging in A, management accounting, B, cost accounting, C, financial accounting, and D, tax accounting.
Financial accounting.
Financial accounting.
Financial accounting.
And any other
Financial
question, any other
accounting.
answer? So everybody says financial accounting.
Management
All right.
accounting.
Somebody say management accounting A. Okay.
Yes, management
And
accounting.
you two are saying management accounting A. All right, no problem.
Management
Question 7.
accounting.
Management accounting group A, you are here. Accounted for. Number 7. Which regulatory body would a Nigerian company submit its annual returns to? A. This one is deep. Nigerian Exchange, that's a stock exchange. B. Federal Inland Revenue Service,
Federal
FIRS.
Inland Revenue
Wait,
Service.
nah, I don't like this. So
Yes.
C. CAC, Corporate
Ewele.
Affairs Commission, and D. CBN. Which regulatory body would a Nigerian company submit its annual returns to? Oh yeah, what's your answer?
Federal
Federal Inland
Revenue
Revenue
Service.
Service, FRS B.
That's B. Any other
But I
person?
think FRS changed to NIRS or something.
This was
Correct.
as at NRS is as at
Corporate
1st of
Affairs
January
Commission.
2026. Somebody say C, Group C. Any other answer?
Yes, C.
C. Okay. All right. People should be collating your answers. No. 8. Bookkeeping is primarily concerned with A, analyzing financial performance, B, making business decisions, C, recording financial transactions, D, preparing budgets.
Recording
say
financial
C.
transactions. C.
C. Good. Number 9. The Tony Elumelu Foundation would most likely use which type of accounting? A, commercial accounting, B, government accounting, C, non-profit accounting, D, cost accounting.
Non-profit
C.
accounting.
Profit account.
Sorry, say that again.
Non-profit accounting.
Non-profit account.
C.
Non-profit
Okay,
accounting.
non-profit accounting, C. The final one, number 10. Historical accounting deals with A, future projections and budgets, B, current day transactions.
Sorry, please. Hello.
Yes, I can hear you, sir.
For clarity's sake, I just heard you saying that the answer is non-profit accounting. Meanwhile, at the beginning of this session, you said there are 2 types of accounting. That's
I didn't say that, though. It's your colleague that said it, though. I'm just repeating what they said, though. I've not gotten to the answer yet.
I'm thinking the answer is government accounting.
For Tony Elumelu Foundation, government accounting. Okay, that's so you are team B. Okay. Number 10, historical accounting deals with A, future projections and budgets, B, current day transactions, C, past transactions and events, and D, tax calculation.
Past transactions and events.
Past transaction and events.
Fantastic.
C.
C. All right. And now for the unveiling. Answer key. Okay. So, number 1, our answer is B, Financial Reporting Council of Nigeria. The FRCN is responsible for adopting and implementing IFRS in Nigeria. Let me see what your answers were. Forgive me, we have to go up small. But it's fine. We'll do it. So B, you are correct. The second answer, C. Our question was, what's the primary difference between accounting and bookkeeping? Don't worry, I'll send the answer. I'll send this to you. So be scrolling up and down. Anyway, some of you will not believe me. So let me be going up and down. So our answer is C, right? Accounting includes analysis and interpretation, while bookkeeping focuses on recording. That's the fundamental difference between the two processes. So how many of us got that answer? C is correct. Number 3, the answer says what now? The answer is B, government accounting. Government ministries use government accounting for public sector financial management. And you were right. So the controversial A. Then controversial question 4. Let me read it again. We said, if MTN wants to analyze the profitability of its operations in different Nigerian states, which type of accounting would be most useful? Some of you said A, some of you said C, some of you said D. And the correct answer is C, management accounting. Can you see the reason for that? Internal analysis for management decision making falls under management accounting. Can you see? These are your questions will come out to. MTN Nigeria wants to analyze profitability within its own operations, not between MTN and 9Mobile, MTN to MTN. And we said that management accounting is for internal users, who want to make a decision. So it is going to be management accounting and not financial accounting. Financial accounting, I told you, is for external users, people that want to use it to do, maybe you are financial account. Financial accounting is mostly used for external users, shareholders, investors. I said that initially. Okay. Number 5, the question says, which of the following is not an objective of accounting? Providing entertainment. So you were all correct on that. So B, correct. So question 4, the correct answer is C, management accounts. Okay. So now question 6. Thank God I don't have to be going up and down. Question 6 is here. The correct answer for question 6 is C, financial accounting. See it here again. Annual reports for external users like shareholders are part of financial accounting, not management accounting. Sorry. A company like Dangote Cement preparing its annual reports for shareholders will engage in financial accounting. In fact, when you see this language, annual reports, we don't use that when we are talking of management accounting. We use annual reports for financial accounting. But when you are talking of budget analysis, cost analysis, that's a management accounting purview. It's a management accounting item. But annual report, financial statement is financial accounting purview. So the answer to this is C. Number 7, which regulatory body would a Nigerian company submit its annual returns to? B or C? Correct answer is C, Corporate Affairs Commission. Companies submit annual returns to CAC for regulatory compliance. Regulatory compliance. Which regulatory body? Is FIRS a regulatory body?
Yes.
Maybe you ask your law lecturer. I can't say for sure. Okay, for my quick definition here, they said FIRS and CAC are 2 distinct government agencies with different roles and responsibility. The FIRS is responsible for collecting and administering tax, VAT, and other federal taxes. It ensures compliance with tax laws and regulations, collects taxes from individuals and businesses, while the CAC is responsible for regulating and supervising the formation, incorporation, and management of companies in Nigeria. They also ensure compliance with company laws and regulation. So FIRS focuses on taxation, while CAC focuses on company registration, regulation, and compliance. Well, maybe we'll give this to both of them, FIRS and CAC, in this context.
No, I think you're
Question?
correct. CAC only. FRS doesn't have
CAC
any
only.
funds.
Thank you, ma'am. I really appreciate that.
All right.
Question 8 says bookkeeping is primarily concerned with C, recording financial transactions. You were right. C, you were right on that. 9, Tony Elumelu Foundation will use what type of accounting? This one was a no-brainer. I was surprised. Non-profit accounting. Charitable organizations like foundations use non-profit accounts. Somebody was trying to say that I said government accounting, but Tony Elumelu is not a government entity. Remember I said that when we talk about non-profits, you have the government because they are focusing, their focus is not on profit making. And then you have what we call NGOs. But see, but for this one, the accounting they will do, like I was telling you, is what we call public sector accounting when you get to skills. I can't use NGO for public sector accounting because I remember that they have their own separate set of standard, which is called IPSAS. I'm sorry, I'm going beyond, but I just need to clarify. They go by a separate set of accounting standard called IPSAS. NGOs are not like that. NGOs, the only reason why they fall under non-profit is because theirs is for efficiency. And they would be falling under some other things like that, even that environmental accounting, but not really. Depending on type of NGO, they would have their own special distance. So in the options available, the best option would be that non-profit accounting, because they told you here that it's Tony Elumelu Foundation. Tony Elumelu Foundation is not a government agency. So the best option here would be C, not B. Then, of course, you guys got this one. Historical accounting deals with past transactions, and that is C. Recording and reporting to things that have already happened. So I'm so glad that we got to treat this, and you can now see how the accounting concepts work together, how they are interwoven. Now, I said that, please remind me, the format for your exam. In fact, let me show you. Let me not use then say, so that you will see it by yourself. This is your syllabus. Please read this ICAN syllabus. It tells you everything about your exam. Aha. See it here. Method of assessment. The financial accounting paper is for 3 hours and additional 15 minutes reading time. The paper is in 2 sections. Oh, sorry, I can't switch. Okay, so the paper is in 2 sections. Section A comprises of 20 multiple choice questions that covers all areas of the syllabus. Section B comprises of 6 questions, of which candidates are required to attempt 4. Section B questions will focus on specific areas of the syllabus, which we do not know. But this section A, 20 multiple questions, I attempted to answer the last diet 20 multiple questions. Almost, if you are not practicing, the thing requires you to know the syllabus have it on speed dial. So please try and practice, learn, study. You can see how questions like this this little example that we have done now, you can see how options can look the same. Time permitting and God willing, I'll be bringing up, this class is going to be, this is the only topic that is talk like this. So other ones, we are going straight to solving questions. I hope that's fine with us. All right. As an accountant, there's something else that you need to know. And okay. So thank you so much for that. for agreeing with me. An accountant, there's another part you need to know, which is called the fundamental accounting concepts. When we're looking at the breakdown of topics, I think you saw it there, the accounting concepts. Now, why we need to understand, even me, I underrated the beauty or the importance of this accounting concepts. Somebody trying to say something? Please let's mute our mics for the sake of order and so that you'll be able to enjoy the playback. Oh, somebody's hand. Gania, your hand is up. I'm so sorry. I just saw it now. Gania, Miss Gania or Mr. Gania? Gania. Forgive me. I don't mean to. Forgive me. Let me see. Any questions in the chat? Oh, beautiful. Some people were answering here. I appreciate you. I appreciate you. You didn't want to unmute, Ab. You don't want us to hear your lovely voice in the recording. Okay. Gania Salako. Okay, you know what? Your hand is still up. Do you want to say something? Are we still together? Oh, your network is a bit. You can type your question. Type your question. I'll see it. I thought for November died. Who asked this question? Victoria. I'm sorry for laughing. Please forgive me. Let me be professional. Where did you see that information, please? Okay, for now, maybe by September they'll come up with some. But as of today, July 12, that I know of, your exam is still written. It's still written. Still in writing form. And if it's going to be digital, ICAN will communicate in their usual manner. Okay. Should we take a 5-minute break? Water break. We've done well. This part is reading, basically reading. So we are explaining here the concepts, accounting concepts and conventions. Now, you will be doing something called financial reporting. Like we saw in the definition of accounting, the whole purpose of you learning this financial accounting is so that you can carry out your primary function, which is financial reporting. So you need the skills of a financial accountant. Now, to carry out this financial reporting, there are certain things you need to know, and we call them accounting concepts. Accounting concepts is the why. Forgive my writing, please. Concepts. We call them the why. And we have something else called, this tells the accounting concept tells us the why of financial reporting, financial accounting. And then we have what is called the accounting principles or conventions. And this one tells us the how. You know what I mean by when we say why? Accounting concepts is, how will I put it? Is a guide. It guides us. It guides the accountants. It assists the accountants in recording, in how to go about recording transactions. It tells you why you must. It tells you the purpose. What's the English now? It's like the umbrella, the shield for recording, for summarizing, for reporting your business transactions. This accounting concept now, it also guides the IFRS, the standards that we use in our financial statement preparation. But the accounting principle is more rigid. The accounting concepts, I'm trying not to say that it is flexible. I'm trying not to say that it is flexible, because when something, if you say it's flexible and we're saying that it is the foundation has to be solid. It cannot be shifting. So instead of saying flexible, I would say it is the foundation. It is the foundation of your financial reporting. The financial convention and financial principle is rigid. It is strict. It tells you how you go about. It shows you how to record. So while the accounting concept tells you why you should do certain things, the accounting principles and convention shows you how you should go about it. Is the guide. It's also a guide for what. So is under the quote and unquote your accounting concepts. And what are these accounting concepts? You have the going concern concepts. You have the going concern concept. You also have the accrual concept. Is this place just stay with me. You have the duality concept. There's another, there's a going concern, there's what they call entity or business entity. I keep mixing up this. Let me just call it entity concept. There's one more. Convention, business entity concept. So the concepts are 4. And we'll deal with it now. So what does the going concern say? The going concern concept assumes that a business entity will continue to operate for the foreseeable future. It will not be liquidated and it will not cease to operate. So it will go on in perpetuity. We are not preparing accounts with the aim of losing it. You know that anytime you set up your business, you are assuming that business will live on after you. So entities are preparing that business. They are going about their business activity as a going concern. That's the word we use for an entity when we are saying that you are going to be in existence. If you look around companies that are no longer in existence, we say, okay, let me not go far. So that's the basic concept. The concept assumes that a business will continue forever. It will not be liquidated. It will not be wound down. It will not be dissolved. It will not cease operations. It will continue. So when you are preparing financial statement for a business, you are going to operate. You are preparing it with the expectation that it will operate this year, next year, and beyond. And that's why, when we're talking about financial accounting, comparing performances, that's why you are preparing for 2023 and 2024, believing that there will be a 2025. That's the going concern entity. So the key point here you should note is that financial statements are prepared assuming that the business will continue operating at least for the next 12 months. Assets will be valued based on their ongoing use rather than the fact that they will be sold off or liquidated. Don't worry, I will explain what asset and all these long-term assets means. And we say that long-term assets, when we're saying long-term assets that we will use beyond 12 months will be depreciated over their useful life rather than their disposal value. Don't worry, it will all make sense, but just understand what these concepts mean. If going concern is in doubt, then it must be disclosed in the financial statements. Example, Dangote Cement purchases a truck for 5 million naira. with a 10-year useful life assumption. Under the going concern, you would depreciate that Dangote stock. So when you say depreciation, it means that there is, and when an entity buys, like when Dangote buys this 5 million, we are saying that we are expecting to use that asset, that truck, for 10 years. But you can't lump all the whole 5 million at the end of 10 years. There is a value that you'll be using out of that 5 million. By the time, if you bought it for 5 million in 2024, 2025, you can't still say that that truck is 5 million. Between 2024 and 2025, you have eaten something out of that truck. That eating something is what we call depreciable amount or depreciation. So we are saying that between 2025 and 10 years is 2035. Each year, Dangote Cement will be cutting down on the cost at 500,000. So assuming that the company will continue to operate, if Dangote if Dangote were closing down, the truck would only be worth 2 million. So between 2025 and 2035, if anything happens to Dangote in, say, 2030, you bought the truck 2025, believing that the truck will serve you till 2035, 10 years. But something happened along the way in 2030. The going concern concept is saying that you will not recognize that you bought it for 5 million here. There's an amount that truck will be suffering loss up until 2030. So you're not going to recognize that 5 million. You will calculate all that amount, and let's say by 2030 it will be 2 million. It will now be 2 million. So this truck has depreciated from 5 million to 2 million. That's what it's saying, and you are calling it scrap. But we are not expecting that Dangote will go out of business. We are expecting that Dangote will use its assets forever and ever, as it has said, 10 years. So that's what the going concern concept is saying, that a business will operate for the foreseeable future. Before, we used to call it operate in perpetuity, but IFRS has said there's nothing like perpetuity again. We say for the foreseeable future. All right. So that's basically it. This is just a simplified definition, but it is okay at your level. You don't need to go beyond that. Accrual concept says that transactions are recorded when they occur and not when cash is received or paid. So for this accrual concept, we have it goes with a principle called matching principle. So in some textbook, in your textbook, you will see accrual concept in brackets, matching principle or matching concept. What we are saying is that transactions are recorded not when you receive cash or when you pay cash, but when they occur. So it's like recording your exam results. Many of you did exam in May. Results came out in June. Some of us will collect our, like me, I will get my exam slip sometime in August. But it is not when you receive your exam slip that results came out. When did results come out? Results came out in June, but exam slip was in August. Accrual concept is saying that you will record your exam results as at that June when your results came out, and not when you collected your exam slip. Okay? And the key point here is that revenue is recognized when earned, regardless of when payment is received. Expenses are recognized when they are incurred, regardless of when payment is made. And then this concept ensures that income and expenses are matched. You can see the matching principle here, are matched to the correct accounting period. So let me say here, there's something in accounting called an accounting period. Every business has it. And it's very, very important in when you want to set up your accounting record or record your transactions or prepare your statements. So some businesses, every accounting period is assumed to last for 12 months. Correct? That's why you see financial statement, annual reports where they will say as at December 31st, 2024. This means that the accounting period is 12 months. That will be starting from when? January 1st to December 31st. If you have an accounting period that says as at March 31st, 2024, please, when is the accounting period? When is the accounting period going to start from?
1st of April to 31st of March.
Call it in full. Call it in full. 1st of April when?
2023 to 31st of March 2024.
Fantastic. To 31st March 2024. Then there are some people that will have their own accounting period from June 30th, 2024. Please, when is their own accounting period?
1st of May 2023 to 30th of June 2024.
You can see I'm not writing. No, it's not correct.
No, sorry.
Somebody else. Try, correct yourself. June 30th. This
Okay.
accounting as at June 30th, 2024. Yeah, I'm listening.
July,
Okay. July.
1st of July 2023.
1st of July 2023.
Thank you.
30th of June 2024.
Yes. All of you that are filing, when you are filing your VAT, 30th June. So that's your accounting period. The last one I'll say now, for people whose accounting period is September 30th, 2024. When is your accounting period?
1st of October 2023 to 30th of September 2024.
Clap for yourself. Someone should give a clapping emoji. Yes, thank you very much. Thank you very much. There's a reason why I'm saying this. So hold this.
I have a question.
No? Please go ahead, sir. Yes. Let's brainstorm
You
together.
just said the accounting period is 30th September, and are you skipping that date and starting the next day? Why is that day not inclusive?
So once upon a time, don't mind. Actually, this thing, accounting, in the history of accounting, what they say is that 30th September is equal to 1st of October. I don't know how to explain it. So they would, so this 30th September, the reason why they don't want it to be, the reason why it is not 1st of October 2024 is because of something that we call, I hope I'm not going to, is in audit, is something called cutoff period. For the accounting record to be accurate, the business must have a cutoff period. And so the IASB, or accounting standard setters, have said that let that cutoff be 12 midnight of the preceding day for the accounting period. Do you know what? Do you understand what that means? It's basically the same thing. 30th and 1st are basically the same accounting period, but for the sake of cutoff, because if you enter 1st of October, how am I going to, how will you record your financial transaction? There has to be a stopgap. That's why your financial statement, your balance sheet, let me call your balance sheet or statement of financial position, will say statement of financial position. It wants to tell you your financial position as at 31st. The business can be continued for 1st of October. So as at 31st December, as at 30th September, as at 30th June, like that. But we are saying that we cut off all recording of transactions on the 30th of September. And then we now start a new period, fresh period from 1st October 2024 to 30th September 2025. So it's because of this thing, this I won't call it concept, but this occurrence, cutoff. And that's why even your income statement will tell you statement or income statement statement, let me say income statement for the period ending or period ended 31st December 2024. Cut off. Does that answer your question, sir? Because of this thing called cut-off period, that's why we have to have a stop gap for recording transactions. If not, you won't be able to capture transactions accurately. You won't be able to give importance, and that's why we notice. That's why we have historical costs as a convention, as a principle. That's why they say when we get down, you see that they say record your transactions based on the costs, historical cost, as at what it was. Even your financial statement is a historical financial statement. Is a history. It's telling you what happened between first to this 12-month period gap, this 12-month period that we're operating. This is the story of our transaction. This is what happened. So because of this thing, that's why we cut it off at 30th, and we are saying that a fresh period begins from first 12 midnight. So if your customer pays in money, if you sold goods at 11:59 p.m. on the 31st of December 2024, and then the person paid you 12:02 a.m. 1st of January 2025, you cannot record that money as a 2024 transaction. You cannot you will record like we said, you will record accrual basis. You will record it as a transaction that occurred, but you will recognize it. But the money, you cannot recognize that money in 2024. You have to recognize that money in 2025. So let me not go far. We will call it a receivable, what we call receivable in 2024. Sorry? Please, but you understand what I'm saying? So any transaction that occurred 11:59, if the money came in 12:02 the next day, it will not form part of the revenue for the period that we are reporting, 31st December, because we have cut off all transactions as at that point. But there is a system using double entry principle. There's a way. It's not like as if you won't record that transaction at all. You will record it, but there's a principle that we use, double entry principle that we use, and there's a system that we are going to employ to recognize and report it accurately, so that we will not overstate our results. Okay, so I hope that is clear to us. The next concept.
Sorry, I have a question, please.
Yes, please go ahead. Sure.
Please, I'm still struggling with matching concept and accrual concept. Can you explain more?
Sure.
Thank you.
So the name of the concept is accrual. But the name of the concept is accrual. It is the same thing as matching principle. So accrual and matching are the same. But under the name, how will I put it? Under the naming ceremony, forgive me, but in the naming ceremony of accounting concepts, it is called the accrual basis. As I said, in most textbooks, you will now see them put it in brackets, matching principle. Here, that's why I put it here. They are the same thing. So what we are saying is the accrual concept and the matching principle says that recognize or record transactions. See it here. Record transactions when they occur, not when cash is received or when cash is paid. So like this, my same example here, this accounting period thing. We are saying that you won't say that because you received money 12:02, 12 a.m. on the 1st of January, but you sold goods 11:59, 31st of December. Where are you going to record it? Which day, which period are you going to record it? Matching principle said that 11:59. So the accrual concept is saying that don't look at regardless of when you received money or when you paid for money, recognize the transaction the day at the point of occurrence. So I have an example for us. I hope I'll find it.
Okay.
I have an example. Where is that example? I found it in our textbook. Hey, I hope I did not delete it. Very, 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 very sweet example. Okay, I will get to it. Let me just touch on this one. Please remind me of that your question. of that example that I said for accrual.
Now, can I
Oh,
say something about what I
yes.
believe this is?
Yes, please
Like
go on.
in my own way, does it mean that accrual concept says that you should record transactions once it occurs, regardless if you are paid at that point or not? Is it the same thing?
You are 100% correct, ma.
Thank you very much.
Yeah. So see it here. You just said you record business transactions when they happen and not when the money changes hands. So for revenue or income, you recognize revenue when you earn it or when it occurs, regardless of when the payment is received. This revenue has to do with sales. So you recognize the sales, whether your customer pays you the money immediately or on credit, you recognize the sales. Expenses too. If you are buying goods, you recognize the expense or your purchases at the point or the day you bought it, not the day you paid the supplier. Okay, so the example here says a Lagos-based consulting firm produces services worth 200,000 naira to a client in December 2023, but he received the payment in January 2024. Can you imagine the same example? So under accrual, the revenue is recorded in December 2023 when the service was provided, but and not in January when cash was received. I think this is clear, crystal clear.
Okay, it is for me, but then I think about if you record it as that you have done a transaction or you have made a sale, then how do you now know that it's still a receivable and that you haven't collected the money involved?
I do not want to jump because now we are going to enter into not at all, but you are right. That's a very good question. So hold that question in your left hand. In fact, there are plenty of things now in your left hand, but that's the head. So that's where double entry principle comes in. That's why accounting is telling you that there is a format for recognizing those transactions. That money never lost. That money is not lost. That transaction is not lost. It's just that there is a way that we are meant to recognize it. Okay. All right. So duality concepts. You're welcome. Duality concept states here now that every transaction has two. See, it's as if they were reading your mind. Every transaction has two aspects, and it affects two accounts in the accounting system. So this example says, my explanation here says like Newton's law for those of us that do not do physics. But for every action, there is a corresponding or opposite reaction. It's the same thing in accounting. Every transaction has two sides. For every, in fact, in primary school, no, not primary school, sorry, secondary school, my teacher would say, for every debit entry, there is a credit entry. For every credit entry, there is a debit entry. Don't worry, you know what that means. But that's it. If something increases, something else must decrease by the same amount. If two things increase and decrease by order, if two things increase, one must decrease by the same amount. So the key point here is that this duality concept is the basis on which we are doing our bookkeeping, double entry bookkeeping system. For every debit entry, there must be a this is what I remember. For every debit entry, there must be a corresponding credit entry and vice versa. There is something called an accounting equation. Accounting equation says that assets, so let me use A. A stands for assets equals equity plus liability. This accounting equation says that this debit side is it left or right now? Depending on where you're looking at it from. The left side must always equal the right side. That's what duality concept is saying. So this will ensure mathematical accuracy and completeness. You will see, don't worry. So look at this example. When ShopRite purchases inventory for 500,000 naira, see we are going far, but this is the double entry principle. This is the duality concept. Inventory account. So now when you make purchases, inventory account will increase by 500,000. By the way, inventory is an asset. So when we get there, I will show you, I will list out everything that makes up assets, the things that make up equity, and the items that make up liability. Don't worry, but just read this example with me. So that means that after this class, go back, read these notes and assimilate it again. Now, see, ShopRite purchased inventory for 500,000. Their inventory increased, but something had to reduce. What is that? Who can just read the second line? To purchase that inventory, something had to give. Cash. So two accounts were affected, two sides. One side is assets. So they are both assets, but they are different types of assets. Cash is an asset, inventory is an asset. So now one side of inventory increased, one side of assets increased, another side of an asset reduced. Something must give and take. So the two sides have balanced. 500 minus 500. So look at it now. So if asset cash and cash now, the two sides balance. Cash reduced minus cash plus inventory that increased plus minus. Sorry, I'm going fast. I don't mind my nerd brain, but everything is just zero. So both sides are balanced, is equal. There is no side that is higher than the other, and that's what the duality that's what the double entry principle is trying to prevent. That you won't say 10 is equals to 12. In mathematics, 10 is equals to 12 minus 2. 10 is equals to 10 plus 0. 10 is also equal to 9 plus 1. So in accounting, we are trying to say that any accountant that comes and now tries to tell you that 10 is equal to 8 plus 3, there's something wrong with that accountant. In double entry principle, the left side and the right side must always be equal. And you see it when you start preparing accounts. Now, we've come to conventions or principle. This is one of the principles now. So I know there's still one more concept, but I'm following the order of my notes here. Accounting principle says historical cost. Historical cost is a how. And it's saying here that for assets and liabilities, we record them at their original cost at the time of acquisition. So this is a principle. It says here that this is like keeping the original receipts for everything you buy. No matter how much the prices change later on, you first of all record it for what you actually paid for it. And the key point here is that it provides us with objective and verifiable value, measurable value. It is easy to audit and it is less. So there's no mago. When we look through your documents as a company, we can see that this is the cost for which you purchased assets, and this is the payment receipt or evidence for which you settled your debt. And then but bear in mind that it may not reflect current market value because, of course, now timing difference. You bought a car January 2025. When you bought the car, you recorded it at 5 million or whatever, however much you bought it. When you are reporting by June or July, you can't quote that original car. And remember the example I gave you, depreciable amount, something has come out of it. So we are not saying that you're not looking at the car based on how much Corolla is now. Maybe you bought your Corolla 5 million in 2002. In 2025 now, you now say, oh, how much is Corolla at 2025? That's not what we are saying. Historical cost, how much did you pay at the time of acquisition? Record it then that way. And then as you apply other convention, other principles, accountants will adjust it to reflect current trend and practices. Okay, if you do accounting very well, there is no error, there's no fraud. There's only fraud when you are trying to achieve the impossible. That you are trying to do mago with the accounting equation. All right, current cost convention. It says that assets and liabilities are valued at their current price or replacement cost. This is like updating the value of your phone based on what it will cost to buy it. Based on what it will cost to buy that same phone today and not what you paid 2 years ago. Okay, so this one, it seems like I'm contradicting myself. But depending on the type, remember I said, depending on the type of report you are doing. Remember when we're looking at scope and purpose of accounting, we said historical costs or historical cost accounting is for when you are preparing your annual report. We said it when we're doing accounting based on not entity, but based on users, when you're preparing your annual report for shareholders. And then the current costs is like an internal analysis when you are preparing your daily sales reports. Remember when I gave the example of Jumia and Temu? So this current cost convention applies to that. It's saying that depend for the report, if you are doing a sales report, or you are entering your record into your ledger, you have to record it using up-to-date current value of that asset. We'll explain. A company in Abuja purchased land for 10 million in 2015. By 2024, similar land in the same area cost 25 million. Historical cost shows 10 million. Current cost shows 25 million. Given Nigeria's inflation, current cost often provides more relevant information. Now, what we are saying here is the good thing that they used land, because land does not depreciate. If you bought land in 2015, it says here for 10 million. In accounting, we don't depreciate land. What happens is that the land has appreciated, right? In accounting, when we get to what basis of accounting, there's a way we measure, and we measure based on not net realizable, fair value. Land will now be recorded or recognized at its fair value. So that 10 million that you recorded it, when we are doing when you do your calculations and you update it you update your statement of financial position to reflect the new cost of that land at 25 million. It's something. So the difference of 15 million is like a gain on that land, and it will be recorded in your retained profits. It will boost. So this money goes into the shareholders fund. I don't want to be too technical. It goes into what is called the shareholder. It goes in as retained to the retained profit as it's revaluation. The land is revaluated. So this amount, 15 million, is called a revalued amount. It will be added to the shareholders, and it will boost their share, the equity, the owners and shareholders funds, and the account to balance. So what happens between 2015 and 2025 is that for that land that you bought, we will now recognize it at its current value. Though in 2015, where you bought it, you record the amount you paid for it was the historical cost. But between 2015 and 2025, we have revalued that land, and it has shown us that current market price for that land is 25 million. It will not be fair for the business to continue carrying that land at 10 million in its account, which is why the accounting convention says revalue that land and recognize that land at its current market price of 25 million. But that difference, we have to account for it properly through a lot of calculation and debit, credits, and all of that. That 15 million difference is called revaluation gain, and it is added to equity, shareholders' equity. I will show you, or owners' equity. The next concept or convention is materiality and aggregation. Information is material if its omission will influence the economic decision of users of financial statements. That's what we call material. So we call it materiality. Now, it can be material individual on its own, or it can be material in an aggregate manner. That's when you add the sum total. What do I mean by that? GT Bank now. You know GT Bank, right? Many of us bank with them. If in their revenue or something happens in their accounting statement, if there's an error, let me say they have a revenue of 60 billion, let me be modest, 60 billion. But somehow that month's reporting, you saw an error of 5,000 naira. Will you say that 5,000 naira, when you compare it to 60 billion, is it material? In the whole of GT Bank's revenue base or worldwide global reporting for GT Bank, 60 billion naira. Then some auditor discovers an error worth 5,000 naira and says, no, we should cancel that. And that's GT Bank, they lied because of this. No, you won't, because this 5,000 naira error is not material. Given the size of the entity, GT Bank. But if we come to you and I, let's say Bukola now. Bukola has a business. So this is GT Bank revenue. Bukola's business, Bukola's revenue. Modestly, our revenue is 60K, 60,000 naira. And then she now discovers an error of 15,000 naira. Maybe somebody did not add it, or they did not, or somebody removed the money. They discovered an error. When they record the person made an error of 15,000 naira in her books. Will this error be material to her or not? Will it influence her decision? So, like now, because of this error now, Bukola's profit is now being reported at 60 minus is now being recorded at 35,000. When ordinarily it should have been 60,000 naira. That these are her revenue. But because of this error, they are now reporting her revenue at 35. Why am I even going far? Your salary is 60,000 naira. HR now made mistake, or Mr. Auntie Grace now made a mistake and transferred your salary 35,000 naira. They made an error and deducted 15,000 naira. Is it material? Or is not material? Will it be material? Will you shout?
It's material.
It's material. But if your salary is 60 billion naira, and GT Bank made an error, or your accountant made an error and transferred 60 billion minus 5,000 naira, is it material? Won't you be like, let them take it for Coke, let them use it for Coke? So depending on the size of the entity, because of how the size and the nature of your business, that is how you now decide. That is how the materiality is decided. Materiality of a transaction is weighed. For instance, in this same case now, so that's materiality for one transaction. When we are talking of aggregates, if this 5,000 naira error occurred in 100 branches, like we used to say when they are catching fraudsters, okay, I'll get there. Multiply this 5,000 naira times 100. How much would that give you? That's an error of, it's even still too small compared to 60 billion. But let's just say 5,000 times 1,000. That's an error of 5 million. It is material here because it occurred in this large sample. In 5,000 naira missing or error from 1,000 branches, and is a consistent thing. It will flag something in you that, hey, there's something going on here. So we are saying here under the materiality concept that if information is material, if it's omission or misstatement, you can see in the first one, there was a misstatement of 5,000 naira. In Bukola's case, there was an omission of 15,000 naira, but it influences the decision of that user, of the person using it. Then we call it material. So material is important. It is the difference between losing 100 naira and losing 100,000 naira. One might not affect your decision, but the other will certainly affect your decision. So in accounting, we focus on amounts that will actually matter and affect decisions of the users of accounting. So I said here that materiality depends on the size and nature of the item in relative to the company. You can see the difference between Bukola and GT Bank. Immaterial items, when grouped together, can become material. Understand that too. It reduces, the reason why we regard materiality is because it reduces unnecessary detail in financial statements. The threshold varies from company size and industry. So what is immaterial to GTB might be a big case, or will be a major issue with a bank like Wema Bank. You understand? So here I said a 50,000 naira error in GT's account. GT that has billions in assets might be immaterial, but that same 50,000 naira error for Bukola's cake business can be material and will significantly affect her decision. Maybe she will decide that I can't use this accountant again. So hiring decision will be affected. Banking, you might say that if it was a bank that made that error, how many of us it has happened to a lot of us now, when Zenith or Access Bank was debiting us anyhow, some of us said we are never going to use those banks again, and we went to open Money Points and OPay, and we are fine. But their error affected your business decision. Chicken now. That's just so you can see how just explain these things this way and see how to break down complex concepts in your mind so that you understand. Okay. The next convention is called substance over form. Here we are saying that transactions should be recorded or recognized according to their economic substance rather than their legal form. What does that mean? Economic substance, that is, recognize them according to the, let me say, the cash in hand versus the idea. What does this mean? It means that we are looking at what really happened versus not just what the documents are saying. So if somebody says, oh, I own a house in Banana Island, you won't just take the person's word for it. You must look, apart from looking at the C of O, you must go there, verify. You must also confirm from person's account that, okay, this money left the account to purchase this particular asset. That's the substance. The economic substance is the money spent or the cash or the asset that was discharged in order to attain the other asset or that claim. Okay. For instance, in terms like substance over form for loans, if a company is claiming that, or if a bank comes and says that, Mr. Gideon collected money from me, you won't just take the form of the accusation. You will go and look at it. Mr. Gideon, bring your account statement. GT Bank said they gave you 2 billion naira between the period of so and so. Let's to invest, to confirm, to determine the economic substance. Let us know, did this money actually enter your account? I'm just basically saying that, breaking it down to show you how it works. And we are saying that we focus on the economic reality of transactions. It avoids manipulation through complex legal structures. We are ensuring faithful representation of business activities. And we are particular, okay, when it comes to it's particularly important for those for lease accounting and special purpose entities. What do I mean? You know, under lease now, okay, let me look at this example. A Nigerian company signs a lease agreement for equipment. Legally, it will appear as if, you know, lease is like rent. You get long-term lease is actually rent, long-term rent. But the agreement has said that the company must pay for the entire cost of the equipment over 3 years, and that at the end of 3 years, the company will now get ownership at the end. So even though you have called it lease, but because economically we are going to get the ownership of that asset comes back to us after 3 years, it is not lease again, it is purchase with financing. What do I mean? You know, you can buy something and pay over instrumental payments. Instrumental payments for an organization is called purchase with financing or refinancing. So it's kind of like the supplier is giving you a loan, but at the end of the year, they are not, or the end of the agreed tenure, you get the equipment becomes yours. So it will also affect. So when you are recording it in your book, you will record it as buying, maybe book as a, how will I put it, purchase with long-term, like a long-term liability. You won't record it as a rental expense. So when we are treating all those things, accrual, prepayment, and things like that, it should be broken down for you. Okay, we're almost there. It's 70% done. The next is what we call the business entity concept. So that was what we call entity concept at the beginning. And this one, I'm going to tie it with another thing called stewardship. You know, I said in the middle of our explanation that the accountant is like a steward. So here we are saying that every business has two forms. A business can either be sole trader, jumping ahead of myself, or it can be a limited liability company, LLC. Oh, sorry. And the sole trader partnership. There are three forms: sole trader, and a partnership. Okay. So I'm talking when it comes to business entity, I will explain from the angle of a limited liability company. So it says here that the concept treats the business as separate and distinct from its owners and other entities. So this is like having a bank account for your personal money and then bank account for your company. For those of you that do side hustle, that have separate hustle, you will keep two accounts. Even if you own the business, if anything happens, you spend anything that has to do with you personally, you will spend it from your personal money. Anything that has to do with the business, you spend it from the business account. Though most CEOs don't do that. But that's what we are saying. So it is under, but this business entity company, this separating of personality only happens with the limited liability company. For most times, sole trader and partnership, you cannot separate ownership. Ownership and the owners of the business and the business itself are usually the same. They are fused into each other. But when it comes to limited liability, owners, shareholders is different. Is a separate entity from the business itself. The limited liability company is seen like a person on his own that can sue and be sued. I'm sure you've heard that before. So the key point here is that business transactions are recorded separate from personal transactions of the owners. The entity's financial position is reported independently and it applies regardless of the legal structure. I will explain this better. This sole proprietorship, partnership, and limited liability, it doesn't work here because when it comes to the entity concept, the person of the owner and the business are usually the same. So in terms of debt, that's why the liability for the sole trader is unlimited, and that of the limited and that of owners of a limited liability company is limited, because in the case of when there's going to be wind up, when they are being wound up or you need to be paid debt, everything they can collect the sole trader shoe, bag, even sell the person's children and children's children to pay off the debt. But for a limited liability, they won't touch you. It's only the asset of that business that will be liquidated to pay off the debt. You get? So it enables meaningful financial analysis and comparison. So here I said here, if Mrs. Adebayo owns a boutique in Lagos and uses 30,000 naira from the business cash register to go and buy groceries for her family, this will be recorded as a withdrawal from the business. It is reducing the business's cash. It is not a business expense. The groceries are for her personal expense, not for the boutique. So that is how the accountant must separate it. Though sometimes some CEOs will come and tell you, put it under entertainment. To tell you put it under entertainment, that is not it. You will deduct it from the owner's funds as drawings. Okay. And the next one is called fair presentation. Fair presentation is talking about the financial statement. It's saying that financial information should be presented fairly, objectively, without bias and without error. It must provide true and fair view of an entity's financial position and performance. This means that it should give a clear, honest photograph of the business health, the business health of that company. It should not be filtered, it should not be edited, it should not be cleaned up, window dressing that will hide the problem or share over, tell you that you are making like many fintech. I'm sorry to say if you are a fintech, but I feel like a lot of fintechs are not giving fair presentation of their businesses' financial health. That's my opinion. Many of them, because if it was so, why is that small shaking in the system, all of them are collapsing, they are falling apart? What's going on? Okay, so here under the rules for fair presentation is that information should be relevant, reliable, comparable. It requires adequate disclosure. That means as the owners of the business, you must give transparent disclosure of information. Presentation should not mislead users. overrides other requirements if necessary in order to give fair presentation. Particularly important for investors and creditors who want to make financial decisions or even acquisition decisions. So if a Nigerian company knows that a major customer owes it, that is, if you know that your customer that is owing you 2 million naira is likely to go bankrupt, fair presentation requires that you, as the accountant, should disclose this in the financial statement. So when we are talking about financial statement, we have what is called notes to the account. It is in this note to the account that companies are expected to give fair presentation of things that you cannot say. Maybe anything that does not have, the account is for monetary recording of financial activity. So things that don't have a financial metric or financial measurement to it, but you have an idea. You like this one now is saying that you suspect that your customer will go bankrupt, and in your books they are owing you 2 million naira. Fair presentation says you should disclose it in the notes to the account. All right. That to show that there is a risk that one of your customers, especially your faithful customers or your key or primary customers, might go bankrupt, and then this money will be lost. So imagine if you are a business that makes revenue of 6 million, and out of that 6 million, 2 million is from this customer, and the person is telling you that this customer is unlikely that this customer will be able to pay you back. That means your profit or your revenue is going to slide to 4 million. Is a material information. So you can see it's material, and therefore it must be disclosed. All right. And then we are almost done. Offsetting. So many times we confuse offsetting with matching. They are not the same. Matching has to do with the period. Offsetting is about transactions. And it is saying here that asset and liability, or income and expenses, should not be offset against each other unless specially permitted or required by an accounting standard. Can you see? That is different from saying that matching principle or accrual principle is saying that recognize revenue in the period when it occurs and not when cash or payment is received. So this is like showing your income and expenses separately on your budget, not just the final amount, but it will give a clearer picture of what is happening. So this example says here that a Port Harcourt trading company, to show transparency, a Port Harcourt trading company has a trade receivable. So you have let me use human beings. Let me use so David is my customer, or is a customer of IoT, and he's owing us, or he bought goods from us on credit for 800,000 naira, 800K. And then we now, IoT, we bought goods from David worth 200K. You, great accountants, will now come and say, instead of me to be writing 800K and 200K, debit David, credit IoT, let me just write there. What will I write? I will now write net receivables 600K. You know where I got the 600K from? That's 800 minus 200, and you put it there. No, you not say, let me offset, let me use 2 to cut 1. In Yoruba, 2 get 3, I did 2 get 4. No. What we are saying, in the accounts, you will state there under what we call accounts receivable. Put it there. Debit David of his 800K, show it. In the payables, accounts payable, on the credit side, put it there that we are owing IoT owes 200K. There is no offsetting. Show it there. We are not, but whenever David or whenever IoT now makes his payments, IoT will now credit their bank can now credit their bank, credit bank of 200K to knock off this account payable. Right? And then David too, you are owing us. David too, pay your money. Pay your money to us, to IoT. 800,000. Let the transactions show. This is not the correct accounting entry. I'm just giving you as an example. The double entry says, let the double entries show. Debit what you should debit and credit what you should credit. Don't offset. So we are saying here that a Port Harcourt trading company has 800,000 in trade receivables. That's customers that are owing us money. And it has 200,000 in trade payable. That's the money that we are owing to our supplier. The company should show both amounts separately in the financial statements. Don't net it off to show only 600,000. This will give better information about the company's operations. Okay, I think that's clear enough. Consistency of presentation says here that presentation of
sorry.
Yes, please go ahead.
Sorry, please, can you like go over it again, like the David part and the IoT part? Can you like go over it again?
Let me. I don't want to confuse you. It's okay. What I said was that there are two transactions in play here between David and IoT. David owes IoT 800,000. And IoT owes David 200,000. Right? If I was an ordinary bookkeeper that I've not done accounts, I would just say receivable. I would just say David. I'm not paying David. I would just say, Dave, don't worry, I'm forgiving you of your debt. Or David just tell me that, yes, sir, don't worry, that's 100K that I'm using, knock it off from my own money. And then you, the accountant, not you, because anybody that's in this class, you won't do this type of accounting. You now write in the books of IoT that David receivable 600,000. You won't, that is in your books, you will just exclude this one. How did this 600K occur? Nobody knows. You in your infinite wisdom, the accountant in their infinite wisdom just recorded 600K. So under fair presentation rule, we are saying no. As the accountant, show it there that there's an account receivable under David's name of 800,000. Show that there is a payable. That is, we are owing somebody 200K separately. You know, the double entry for this now will be to debit 800K, the David of 800K, that's the account receivable, and the corresponding credit goes to an asset, maybe our stock, because we gave out sales. We credit sales with 800K. That's the double entry. So we made a sales worth 800K. This means that we made a sales worth 800K, but we didn't collect money. We sold it on credit. That's why we are debiting David 800K. This is how you should show it in your books. For your payable too, you bought supplies. You made a purchase of maybe purchased stock or maybe shoes. You did, and you've not paid. What double entry principle says that debit the shoes or debit the purchases 200K and then credit your payables. That's the person that you are, because it's a liability, you are owing them. We credit 200K. This is the double entry that we should see in your book. Don't just go and write 600K because you've not paid. When you actually pay, you will come back again and correct it. You will correct it and say, okay, cash, I paid cash for this transaction 200. Now when you make payment, when you are paying out, payments are credited. You credited your account, maybe bank, you paid from your bank or cash, credit cash 200K, and then you now debit the payable because this payable has reduced. This amount has reduced. You will debit it with the 200K. This is the double entry to show that this, when you debit the payable, your what you are owing, it shows that you are not owing again. It has cancelled it. This one, this debit here will cancel this credit, so that payable will now be zero. So you've shown the proper in and out of that transaction. Remember, we said duality. For every credit entry, there's a corresponding debit entry, vice versa. For every debit entry, there's a credit entry. For every credit entry, there's a debit entry. So this transaction shows duality. It shows fair presentation. Unlike when you just put 600K here. I don't even know where to debit and credit in this 600K because you didn't even show me where it was coming from. Is that clear? Is it clear to us?
Yeah, it is. Thank you.
So that's offsetting principle. Now, we are now talking almost there, almost done. Let me see how many more. Okay, we're almost done. Just 2 more left. Consistency of presentation. So we are saying here that this is like organizing your wardrobe the same way each time. Shirt in one section, trouser in one section to make things easy. In accounting, we organize financial statements in financial information in the same way each year so that users can easily compare performances. It enhances comparability, changes in presentation. If you have to change your presentation, then you must justify it. It helps you to even track your identify your trend and pattern, and it applies for both classification and measurement method. I'll show you what that means. So if Indomie Nigeria classifies transaction costs as distribution expenses in 2023, transportation costs, when you are preparing your 2024 and 2025 accounting, you must maintain these distribution expenses. Don't go and change it to transportation in 2024, then call it distribution again in 2025. That's not right. If you decide to change the name to selling expense in 24, then you must explain why and ideally restate the figures for comparison. So what that means is that in your 2023, 2024 accounts, you called one amount transportation, or let me say distribution cost, maybe cost of transporting from warehouse to your sellers in what's that market, Eco. You called it distribution cost. When you are now preparing 2024, you now said, I will change it to selling expenses. We are saying no. If you must change it to selling expenses, then you must go back to 2023 and restate this as selling expenses. So that if I pick up your accounting, your financial statement, I will say, okay, I saw distribution cost in 2023. 2024, I'll now be looking for another distribution, not knowing that you have changed the name from distribution cost to selling expense. So under fair presentation, we say no. Whatever you call distribution cost in 2023, in 2024, let it have the same name. Let items appear the same for easy comparability. I think that's clear enough. Okay. And the last one is the one, prudence. Is there anybody called prudence in this class? Just joking. All right, prudence. Prudence just tells us to exercise caution. Caution in judgment, especially judgment when you are making decisions in uncertain weather or uncertain matters, when things are not clear. Ensuring that asset and income is not overstated and liability and expenses are not understated. The implication is this: if you overstate income, overstate means that you what's in English now? How can English fail me now? When we overstate something, that means we call it at the higher price than it is, Abi. That means we call it, so something was meant to be 60 naira, you now call it 90 naira. You've overstated income.
Is it inflate? Okay.
Yes, inflate. Thank you. My sister, thank you so much. So if you inflate inflate income, do you know that when you overstate income, it means that you have also overstated. If you overstate income, and you understate your expenses, do you know that it means that you have overstated your profits. On the surface, it looks like no problem. That means that You called your income 90,000. You now called your expenses 20,000. That means you now told everyone that your profit is 70,000. Abi? In your mind, you think that you think say you dey wise. When you are now paying taxes, the tax, and let's say the tax man has said that tax is now 7.5. Assuming do you know that your tax, you've now taxed your 7.5% of 70. Someone should help me calculate. Calculate for me, please. Profit before tax is 70. Apply tax of 7.5 on this 70. Please now calculate for me. What does that come to? Hey, accountant with that calculator is like a soldier without. Please call it for me, sir. Eh? What did you get?
5.25.
5.25. That means your net profit. Oh yeah. Subtract 5.25.70.
64.5.
64.75. That means you have now understated your net profits. Now, had it been when you now realize, okay, let's say you made a mistake. When you now correct yourself, let's say moderate, so you now correct yourself, your income that you overstated to 90, you've now corrected yourself, is now 60. Your expense that you understated as you understated it as 20. So you now correct yourself, you now find that actually my income is 30. No, let me say 25. That means your profit before tax is what? This 60 minus 25 gives us what? 35? Is it 35? Yeah. 35, right? Now apply the 7.5 on 35. I want to try something. Please apply 7.5 on 35. %7.5 times 35. Please use your calculator. Let me look for my own calculator.
2,625.
Thank you, ma. So what did you call? 2,000 K. No.
2,600.
35. No, that's right. 35 times.
Yeah, it's 2.625.
7.5%.
2.625, yes.
2.625. Let me just call it 2 points. Can you see? Sorry, here. You overstated sorry. My decision is wrong here. So that means this is the tax that you were meant to pay. 2.625. You have overstated. That means you've overpaid your tax, the tax authority, 5.25, when you were meant to pay 2.625. And then your profit, 35 minus 265, is now so let me say this now minus 35, 32 points. So my actual profit is 32.375. So here I have overstated profits. I have overstated tax, my tax liability, all because I overstated income and understated expenses. In your own assignment, just practice it, reverse it, go and look at the impact when you understate income and overstate expenses and compare. So this is what is meant to be my net profit. But because of this error, look at what I now reported. The impact now is that users will now look at my financial statement and say, oh, wow, bravo, these guys are making fantastic profits. And will now invest or buy or loan, or the bank will now borrow me money because of this overstated profits. When in actual fact, this is my net profit, 32.375. And it is material. The difference, the gap between the two is material. Had it been the bank knew that this was my actual profit, they may or may not have given me as much as it. So based on this one now, the bank will now give me 50 million, thinking that because I'm making profit of 64, she can pay. Meanwhile, my actual strength is 32 million. Maybe if they knew this was they will now give me 15 million, something that will not kill my business. So you can see that prudency and fair presentation impacts decisions of economic decision of the users of financial statements, which is why you must be careful. You must exercise caution. That's what we are saying here. Exercise caution in preparation of your financial statements or financial accounts. So we are saying that it's better to be pessimistic. It's better for you to even understate income and overstate expenses, then correct yourself later than this one that we have done. So it says that in accounting, when in doubt, choose the option that is less likely to overstate how well the business is doing. Choose loss. No, not loss, but be humble. Choose prudence over being what's that word now? Being optimistic. That's why they say accountants are always saying no money. It's better for us to say no money than for us to say that there's money and then you go and spend loud and put the business in jeopardy, in issue problem. So for prudence, it says requires careful estimation of judgment, and judgment prevents overstatement of financial position. It does not justify deliberate understatement. We're not saying that you should deliberately go and understate, but give balanced reporting with faithful presentation. And it is particularly important for Nigerian business environment that is fraught with so much uncertainty. A Nigerian bank is trying to estimate how much money it might lose from customers who cannot repay their loan. Due to economic challenges, there is uncertainty about future repayment. Under prudence, the bank should make adequate provision for expected losses rather than being overly optimistic about the customer's ability to pay. I don't know, those of you that work in the bank, I heard last month, CBN increased what they call prudential guidelines of all banks, commercial banks, prudential guidelines. So what happened? The history of this prudential guideline was CBN. When COVID struck, because the economy was so tight, what CBN did to loosen up the economy was that they told banks to lower their prudential guidelines and give out more loans. So loans were disbursed without so much what's that thing they used to do? KYC. There weren't so many guardrails. Not interest, but the requirements for getting loans, they dropped the bar. You get, they lowered their standard. Now, last month, this was 2020, it was supposed to be like a 2-year or even a 1-year stopgap. But of course, short of people will do something, will not remember. Somebody will now wake up in the middle of the night and say, yay! Raise our prudential guide. I'm sorry. Forgive me. I keep forgetting that I'm not gisting with my friends. That is not gist. Somebody will just wake up and say, prudential guideline, raise it up again. That's what they did last month. And that's how banks were scrambling. Stock prices crashed because of that action alone. You get, so forgive me. So that's what we are saying. So we are saying that it is better for you to be pessimistic than to be overly optimistic. All right, I will share this material with us. Go and read the summary of what I've said. Remember that these concepts, they all work together. They don't operate in isolation. So when you are applying accrual concepts, you must also remember materiality. You must also remember prudence. You must also remember faithful presentation. Okay, and then choose a cautious approach. That's what we are saying as an accountant. All right. We've come to the end of this joyful hour. So next class we'll start on the basis of accounting. I hope I have not bored you. I hope I'll be able to make this course as interesting as possible. I will share this particular material. So I will share 3 materials with you: scope, fundamentals, accounting concept and convention, and basis of accounting. The first 2 so that you go and revise, so that you go and learn again, do the questions again, and then the basis of accounting, so that you prepare ahead, and so that I won't talk too much in that class. I'll just go and complete the last 3. And I know that this week and next week we have finished basis of accounting intro. We'll even touch, so the next, what I want us to, if we can, we should touch conceptual framework. So this is, by God's grace, my target, that we enter conceptual framework next week, and then hit the almighty double entry principle. But anyway, you'll be seeing double entry principle because we are going to start business transactions. When we are talking about business transactions, so I put examples of businesses, of different transactions, simple transactions, complex transactions. Hey, Auntie, please. So when we are looking at those transactions, we'll also be okay, Ganiat, I see your question. I'll answer it now. We'll also be, what was I saying? So when we are looking at business transactions, where was I? We'll also be
Principle of double entry.
Yes, we'll also be fusing in double entry principle when we are looking at business transactions, and then we'll look at financial statements, conceptual framework. All that is next week. So please help me. Maybe I should send the whole material so that you read and prepare. Do you prefer that one? Should I send the whole material, or I'll be doing it as a Netflix unveiling?
I want to send the written. Just don't send the written.
I shouldn't send it so that I won't bombard you. I'll be okay. Let's chat about it in the
No, please don't send everything.
Yeah, I heard you.
Yes, please. Thank you.
No problem. So we'll unveil it small, so that you guys won't be overwhelmed. Yes, and I have a special treat for you. Ask them, my last diet, I'm always giving special treats. So if you go to your to the website, no, not the website. If you log in, log into your IoT, go to, can I do it here so I can show you? I don't want to show people my screen. Let me remember my chats. Let me see how because I set a quiz for us. During the open day, we said, I decided that I want to make this class more interesting and interactive. So I chose to give pop quizzes. You know what pop quiz is? So if you log in, okay, I want to show you, because me too, I have an ICAN account. I can, yeah. You can all still see my screen, right? I'm still sharing. No, not this one. Oh, what's this now? Okay. I want to log into so that you can all see what I'm talking about, the quizzes that I gave. So I want you to go on there. We've come to the end. Okay. ICAN online tutors. Okay, I think this is it. It was logging. Oh. Election has finished too. Should I end it? I'm thinking that I should end the class. But any question? Okay, yes, I saw a question. While that one is doing his own thing, let me see your question. Madam Ganiat. Please open now. Yeah, okay. You said, going back to number 6 question. Okay, why did we pick financial accounting and not management accounting, given that management accounting deals with internal users while shareholders Okay, shareholders who are also the owners of the business due to their capital. Okay. Someone said concerning the offset, I think you want to say offset principle. Does it mean that we are preparing two accounts, that is when the transaction was done and when it is being received? Gift. Okay. Let me start with Madam Ganiat's question. Now, when it comes to financial accounting, I think you are talking about the quiz that we gave, Abby. Let me go up here. Remember I said here that based on users, financial accounting provides information to external users who are investors, creditors, government agencies. They use the income statement, statement of financial position, and cash flow statement. Number 6 question said, let me go back, sorry. It says a company like Dangote Cement preparing its annual report for shareholders would be engaging in what now? Now, see what I said here. When we are doing annual report consists of, I know I didn't tell you this, but it consists of income statement, statement of financial position, and your cash flow statement. When it comes to those shareholders, I remember I mentioned something pertaining to stewardship. You are giving, as a management, Dangote Cement management is giving stewardship to the shareholders. In this question now, the shareholders will be like an external users, because you have what we call existing shareholders and new shareholders. When it comes to annual reports, this is the report we prepare for all shareholders to show them the financial health of that organization. It has not, don't forget, we said the purpose of management accounting is when you want to take internal decisions. You want to take like operational decisions when it comes to, you want to set up a new branch, you want to set up, maybe you want to compare revenue. That's management, is for internal decision making. In this case, the users of management accounting will be managers, executives, department heads, not shareholders. Actually, shareholders will fall under, for the use of financial statement for annual reports, they will fall under external users here. They'll fall under external users. By the time we treat types of businesses and the business transactions that we have, this will be clearer. But for now, just know that anytime we mention things like see here, take this example. Nestle Nigeria's annual report published for shareholders and filed with Nigerian Stock Exchange or Nigerian Exchange. It falls under financial accounting. But for management accounting, we said Zenith Bank's internal cost analysis to determine branch profitability across the state will be is for decision making within the managers, for the managers. And so we are using management accounting. The question said Dangote is preparing annual reports for shareholders. So because it's a annual report for shareholders, just like this example here, we select financial accounting. Let me just leave it at that simple explanation for you. Let me not to confuse. But the further we get into this topic, the clearer it will become why we are saying it is financial accounting and not management accounting. I hope it's clearer. Oh, why? Okay. Lastly, I don't want to keep us, because I know many of us we've been inside. Okay, for the offset principle, yes, you have to, we said the duality concept says you must always have, for every action, there must be a corresponding reaction. So in offsetting, you must show all movements, or if it means sometimes you open for one transaction, you can open as much as 4 or 6 accounts. you must show movements, like 6 or 7 movements for one transaction. You will see it. You get. So yes, you won't just show the net effect of a transaction. You must show all the working, all the movements that affects those that transaction. Yeah, okay, we are here. Very good. Let me remember. Okay, so I hope this is the one. I'm not showing my password though. Okay, thank God. So when okay guys. Anyway, you know what I'm talking about. When you go to your IoT website, please log in the email that you used to log in that you bought your courses. When you get to financial accounting, scroll down after your purchases, you will see pop quiz. Please attempt the quiz there. When I'm able to open this account without showing you my secrets, I will screenshot it and send it to the WhatsApp group. But please attempt the questions. When you do, yes, sir, you want to say something?
Can I
Yes,
share my
please.
screen instead so you can find it direct?
Oh, I don't have the
So today's class is going to be like an overview and introduction.
Why am I hearing myself?
What this course is about. First of all, let me introduce myself. My
Please,
name
who's that? Could you mute yourself?
in
Please mute yourself. Oh my God, that was awkward.
Okay, sorry. I didn't know what's playing. I was asking if I could share my screen so that you can.
I don't have the ability to what's that word now, to share the privilege of what am I saying? I don't have the to others to let somebody else share. I don't think we can.
I think I'm sharing now.
Can
So
you?
I think that's so yeah.
I'm not seeing. Is this you? Are you sharing already?
Yes, I am already.
Okay, so log in. Let me
So this
see.
is my
I've stopped sharing.
dashboard.
Go down.
Under quiz.
Go down. Go to May diet. I'm sorry, no quiz, November 2025. See there.
Quiz, right? Quiz.
Yes, quiz, November 2025.
Okay. All right.
So that's the introduction to financial accounting. So that's the quiz. Please give it a try. So if you can, well, you can give it a try.
done it.
Yay! Congrats. That's good. Okay, guys, we've come to the end of the class. I think I've shared most of the information I wanted to give. So please attempt it. I will try and add more quizzes.
Give tips or something.
Eh?
I think you were talking about tips for something. I don't know what you wanted to say.
I can't remember.
Okay.
I don't remember.
Like the exam. You take something about tips for the exam.
Oh, I thought that's the when I was telling that is multi-choice questions. That's when I wanted to say that your exam format is in multi-choice OBJ. Please go and learn it all. I think I said that.
Sorry, please, you mean just OBJ and not theory at all?
There's there's OBJ and there's theory. Let me show you. Oh, I'll snap it and send to you. But you have 20 OBJ questions, then you have 6 section B questions, theory, answer 4. Answer 4. I will send you the last year's May diet, the way the question format is. For those of you that are just writing it for the first time, I will share it with you so you can see how your questions are, how they come out, okay? And you can prepare. You can just at least have an idea and know what it looks like. Don't let November be the first time you are seeing your question, your exam. You should be familiarize yourself with it, with the questioning pattern, with the format of the exam and all those things. Please, as time goes on, we'll be talking about the exam. But I know one of the killers to good performance is anxiety. And I'm trying as much as possible to ensure that we as students we reduce that anxiety. It will come. I'm not saying that there won't be anxiety, but it will reduce the amount or the level of it so that you can perform very, very well. Okay. And that is done by solving questions. Your confidence grows the more you solve questions. All right, guys, go and eat. Oh, you've tried this after 5. My regards to your family. See you. Those of you that are doing BE, see you tomorrow. For the rest of us, till next week. Right. Bye, everyone.
Bye.